Hello, everyone. This is Dr. Pillay, and I'm here with Paul McManus, my co-founder of the Real Estate Tax Savings Hub. Paul, what do you think about what we're going to watch today with Matt Zagula? Tell us about it.
Yeah, no, this is awesome. So we just had a chance to speak with Matt Zagula. He's the author of a best-selling Forbes book called Smart Retirement, and he's going to show us some strategies that are going to help our community of real estate professionals really think through the tax decisions that they're making so that they can keep more of their hard-earned money and keep it in their pocket.
Absolutely. Paul, could you talk to us a little bit about who this whole Matt Zagula presentation is talking to? The real estate professionals. Who are they? What are they struggling with right now that this is going to speak to?
Absolutely. So this is geared towards very specifically, I would say, a self-employed professional. Typically you have a 1099, you're making $100,000 or more of income, and you're trying to figure out, how do I keep more of that money? Now, a few things that, probably your accountant or CPA's advise is that once you get into that income bracket is the idea of tax deferral. And so there might be terms like a SEP or a 401k that your tax advisor has recommended. And while those things have their place, there are also some more sophisticated strategies available that typically the very wealthy employ to make sure that they're tax aware, so that they're really creating a strategy not just for today, but for their entire lifetime.
And we're going to watch Matt go into a very detailed and lengthy conversation, and I'm excited to just get that rolling. But I just have one more question. Paul, can you tell us why this is not already readily available? Why is it that everyone isn't already implementing what we're about to learn, right? Why is this so precious? And maybe even, if I might use the word, hidden. Why is it hidden?
There's that saying that the rich get richer, right? and there's reasons for that. Is that the rich typically have the best advice, the best advisors, the inside scoop. And so what I love about what Matt did here is that he saw a very specific area that was being underserved in the marketplace. This is something that typically wealthy executives took advantage of for part of their retirement planning, if you will. And he has now made this available at a much broader range for people. So, once again, if you're a realtor at 1099 making, say, $100,000 or more, you now have access to the strategy that before was reserved for people that were very wealthy.
Wow. Well, we're about to watch Matt Zagula. And, when you explained that, I couldn't help but think of Henry Ford. How there were cars before the Ford came along, but they were like very expensive cars. And then this guy decided to make it available for the masses. How could you not love that, right? So we're going to watch Matt Zagula do something very similar. Let's go ahead and watch Matt.
So I think what most professionals who are trying to get ahead today are wondering is, where do I save money so that in the future I have the best retirement that I can achieve? And I think that's a really great question to ask. And I think that there's a lot of confusion around how different types of money works. So one of the things that we realized at Smart 401k plans was the reality that where your money was at may actually have a greater effect on your overall retirement than necessarily how well your investments are doing. I know that sounds absolutely crazy, but you could have a higher rate of return in certain types of vehicles like a pre-tax 401k and get less net income than if that same dollar were put into a lower yielding, a lower return on investment, tax-free Roth 401k. Mm-hmm. So what we wanted to really do was to really help people, especially in professions where it's kind of on them, where you look at a consultant who's by him or herself and they're out there working to make money, or a realtor, who may have a great year this year and next year because the economy really struggled. We wanted to create a very specific type of environment for them so that they can make decisions that are tailored to the type of year they were having. Matt, it makes me think of a really great online marketer that I know, and he was just absolutely killing it for a long time, making a tremendous amount of money. And then the first round of the Google slap came. And all of a sudden, all of that hard work that he put in to optimize his marketing really quickly went away. And as a result, his income dropped pretty fast. So what we need to understand as entrepreneurs is there's an ebb and flow. Our success comes. Sometimes things are a little harder. The one great thing is for entrepreneurs that are used to this, it's part of the game. It's part of something that we understand. But the way we fund for our retirement should be much, much more relevant to the situation that we're having in that individual year. And to this date, something like this really didn't exist. You didn't have the types of plans that can deal with all of these different types of situations until now. And that was really a result of me getting with a very high level third-party administration firm and saying, hey, can I have a plan that does this and this and this? And they're like, really, some Fortune 500 companies may have that, but that's not a normal small company or solo entrepreneur type of plan. So let me tell you what I was thinking about whenever I was asking for all these things, and then I'll show you what we built. How's that sound?
Sounds awesome.
Perfect. So the first thing I realized is that people don't really know enough about the taxation of their money. So I created this little image to talk about buckets of money and where you're saving money. So this pre-tax, tax-deferred account, this is going to be your traditional 401k plan or IRA. And the reason I give this a green light is because if you put $1 into your IRA or $1 into your pre-tax traditional 401k, that's a dollar that you don't have to account for on your taxes, meaning that full dollar goes to work for you in your account, and the government says, we're not going to run that through your payroll. We're not going to take taxes from it. We're not going to count this towards your adjusted gross income. We're going to take this kind of off the top. And the full dollar will go to work for you. So it'll be before tax, pre-taxation. So that full dollar is going to go to work for you. And as that dollar grows and compounds, ultimately, when you take it out in the future, your income at retirement, it's a red light. And it's a red light because we have to stop and pay the tax on the money that we've deferred into the future. And it makes perfect sense. I mean, there's a theory that tax deferral is going to make sense because we're going to retire in a lower tax bracket. So if we're going to retire in a lower tax bracket because our income is going to be lower in the future, it makes sense to pre-tax our money and pay the tax in the future. And it certainly made a lot of sense when these started. And go figure, you know who started these? Bankers. You know why bankers started them? Because back in the 70s, tax rates were astronomical. They were 70, 80%. So the likelihood that taxation in the future was going to be lower was, there was a pretty good shot because they were getting taxed to death. So these bankers figured out how to create a contingent obligation deferred account, a CODA. And CODA ended up being the beginnings of ERISA. And ERISA created all of these pension plans. And the first ones were all pre-tax, tax-deferred plans. Defer money today, pay tax in the future. Now, at the same time, there were also what are called 415 limit plans. And these are after-tax investment and savings plans. So this middle bucket where you see this red light going in and the yellow light going out, let me tell you what this is. A lot of times, a person can put money into their retirement after tax. The pre-tax amount on a tax-deferred account is limited. There's only so much you're allowed to put into your 401k plan. And then they say, hey, that's enough, and whether the company matches or not, there's global maximums you're not allowed to go beyond. Now, if you're over 50, there's a catch-up provision, so you can put even more money into it. But there's also this after-tax investment and savings option under Section 415 of the IRS Code that very few people utilize. But a lot of big company executives in their retirement plan have them. Well, when I saw that, I thought, I want that for Matt too, right? I like that because there's some neat things we can do when we get that money into the plan. So what this is showing you is although you're paying tax, when the money goes into an after-tax investment, the growth is taxable. So when you look at this little dollar sign here at the bottom, you're going to see that it's partially red and partially green. The green is you're always going to be able to get your own money back, right? Because it's your money. You already paid tax on it. It was a red arrow going in. So when you take that money out, you get a return of your money. You don't pay tax. But the money that you've grown inside of that plan, it is definitely subject to tax. So you got some money coming out that's the return of your own principal, but your growth is taxable. Now, when you compare that to the next bucket, the tax-free Roth, the Roth is really interesting, but it's limited. If you make too much money, the government says, oh, no, 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 you can't put money in there. But that's not true if it's in a 401k plan. So for somebody who maybe is a realtor, the usual plan of choice is a SEP IRA, all right, a SEP IRA. The majority of people use a SEP IRA, but it is an inferior structure because you can't fund a Roth SEP IRA. You can fund a Roth 401k. So what we've done is really boiled down big company benefit plans to where now a hardworking realtor or consultant or online marketer can get the same benefits that an executive from a major Fortune 500 company can get. So this Roth is interesting because even though you're using after-tax money to fund it, when you pull the money out, it's a wonderful green light, meaning whatever you pull out of there is not subject to tax. And the difference between the pre-tax and the Roth is significant. Because you see, if I have money in my 401k and I'm fortunate, I don't need it all. At some point when I'm 70 and a half years old, the government says, hey buddy, it's time to pay. You are required to take a minimum distribution. And that minimum distribution, of course, is going to be subject to income taxes at that time. So when we look at this pre-tax tax deferred, although it seems like a good deal because we're getting the green light on the way in, the question is at what cost in the future? Whereas with the Roth, what's going to happen is with this tax-free account that you have, the money that you pay tax on today, all of the growth is going to be tax-free to you in the future. Kind of reminds me of farmers. Farmers are notorious for saying, let's pay tax on the seeds, not on the harvest, because it's cheaper. The seeds are less valuable. So when you look at this structure and you look at this after tax, what we did was we really built a plan that was encompassing all of these buckets. So let's say a realtor is having a really, really, really big year. And let's make it, in my example from the website, Sally, Paul. So Sally's having an incredible year, and she's made a tremendous amount of money this year. Plus, she's married, and her husband does very, very well. So between the two of them, they're just having a fantastic year. So her accountant might say, you know what? Let's fund the pre-tax 401k provision of your plan so that you can defer that income. Let's say for her plan that she could fund $25,000 that year. So she puts $25,000 in. We'll say she made $225,000 that year. She won't pay tax on $225,000. She'll pay tax on $200,000. But that $25,000 will go into the pre-tax deferred account. Now this 415 plan, this after-tax investment, she still can contribute more towards her retirement. She could actually, in this year, she could probably hit about $62,000. And because she doesn't have any employees, because she's technically, although she works out of an agency, a real estate agency, or a brokerage firm, she's technically a 1099 employee. So she can fund her after-tax portion with the difference. So let's say that the actuary says, you know what, she could do $62,000 this year. $62,000. and she put in 25. So that gives her $37,000 that she can put in through the red light here into the after-tax investment. Now, we could just let it go and let it grow, but what the SMART 401k plan does that's unique is it allows her to do an in-plan Roth conversion. So literally all within the plan, she can put it in through the Section 415 limit. She can utilize that additional savings plan that the IRS and the government allow us to utilize to save for our future. But that also allows us to do an in-plan conversion. So this money goes in the same way this money would go in, but she's maxed out. She can't do any more in the 401k. So that counts here. That 25,000 either has to go here, or a portion here and a portion there. She can't do 25,000 here and put any more money into her tax-free Roth. The only place she can get it in, Sally, is through the after-tax provision. That is permissible, and the SMART 401k plan permits that. So she puts that money in, and inside the plan, the actuaries that are working for her, the folks that I do business with, that I have this partnership with, they've been doing it for, as a firm, I believe over 50 years. They've got 3,000 plans. They've got 55 professionals. This is all they do. What they allow you to do is to take that and immediately convert that into a Roth. Now, what's incredible about that, Paul, is that now in her future, when Sally goes to retire, she can push that money out through the Roth, and it's a green light. It's 100% tax-free to her, and it's tax-free in more than one way. It doesn't make any of her Social Security taxable. It doesn't make any of her Social Security taxable, and it doesn't count against her Medicare premiums. So when she pulls that money out, if she's pulling it out over here, that money counts from tax deferred against her Social Security taxes. It counts on how much her premiums are going to be for her health insurance. Here, it's not counting, right? If we take it from Roth, that doesn't count in that equation. If we take it from tax deferred, it does count. So what's amazing about what I just described in this huge year that Sally just had, she pre-taxed like her accountant told her to, but she put an extra $37,000 in the after-tax that she immediately did a Roth conversion and moved that over to the Roth 401k. So in the future, she's got more tax-free dollars coming out. Does that make sense?
Yeah, that makes perfect sense.
Well, and now what's interesting is, not every year is a great year, right, Paul?
Oh, if only it was. Well,
I know. The pains, the trials and tribulations of being an entrepreneur, right? So what we can do is, what if the next year is just a horrific year? And in fact, her husband, who was doing so well the year before, he's not even doing well. And this year they find themselves in a lower bracket. And in fact, it's so bad, she can't even fund this year. She doesn't even have the money to fund because her commissions have gone from $225,000 a year before to diddly squat nothing. So now what can she do? Well, if she's got the right plan like this, the SMART plan, she could say, you know what? We're in such a lower bracket than normal. Why don't we, inside of our plan, do a Roth conversion with the money that I put in last year? Because my tax bracket is so much lower this year because I didn't earn anything, right? Last year was great. The real estate market's fallen out. So now I want to do a conversion of that money. So instead of at the end of the second year, she didn't get to put money in, but where does all of her money live now? It lives all within her 401k plan, all of it 100% tax-free. That's the power of the SMART Solo 401k plan and the small business SMART 401k plan. Does that make sense, Paul?
That does. That's fantastic.
And now is the perfect time. And I'll tell you why. Because when we look at tax rates today, there's a couple things that's always interesting to me. People will say to me, Matt, do you think tax rates are going to be higher in the future? Well, there's really no thinking about it, you see, because right now in 2019, and this should be 19, I don't know why I have a little typo in there. I apologize, my friend. These are the brackets, and these are the top of the brackets. So the way money works is the first $19,400 that we earn, we pay 10% on. And it doesn't matter if I earn that or you earn that. It doesn't matter if Bill Gates earns that. That's what we all pay on the first $19,400. Now that next band, when it goes from $19,400 to $78,950, on that amount we pay 12. And then from here up to here to 168, we pay 22. So it's a progressive tax rate. Does that make sense?
It absolutely does.
And what's interesting about it is these rates, when you look at them, are much lower than they were in 2017. You know, this is lower than that. But the question is, people go, well, it's only 3%. But one thing that's interesting about math is we need to think about the effect, not the rate, because rate's really almost a term of speed. It's not really a quotient of volume. So what that means is that if you look at the same exact amount of income, say, let's call it 70,000 over here versus 70,000 in the 15% bracket, what we need to do to really think about the effect is we need to take out our calculator, right? And if we say, well, you know, that's 3% less, but that's 3% less on a base today that's 12%. So that means for that person on that income is going to be subjected, that's in that bracket, to a tax rate that's not 3% higher. It's not 3%. The rate is changing by 3%, but the tax increase is for them is actually 25% more. So if you take and look at these, I think this is something really important for people to understand. If we look at a 15% rate today, and that's the future rate, because this tax law ends 12/31 of 2025. So January 1st of 2026, it's not a question of our tax rate's going to be higher. They're scheduled to go higher.
Yeah.
Could they go higher than this? Absolutely. Will they? There's some reasons why I believe it's likely they'll be higher than this. But to 12/31/2025, this is the rate we have. But when we go from 12 to 15, the rate of change is 3%, but the tax effect is 3% more than a base rate of 12, which means for the math, we take 3 divided by 12, which means the tax effect, how much more they're paying on that $70,000 when you look at the actual end taxes, it'll be 25% higher. So these aren't small tax reductions. These are large tax reductions. And as we move higher and higher in income, I want to point out an area right here. You're talking about a 9% rate difference there. This spells a huge opportunity for relatively high earning people to start looking at why in the world would we not want to convert some of this money? Now, the reason they might rationalize is because they're going to be in a lower tax bracket. But you know what happens when you end up with an absolute fortune in pre-tax money? What happens is eventually you hit the age of 70 and a half, and the required minimum distribution formula is a formula. It's not like an option.
Yeah.
So you take the 12/31 balance from the year before and you divide it by whatever number the government says, and that is your minimum distribution. We see so many people today where these numbers are astronomical, 100,000, 200,000. Well, how does that really help them control their taxes? It absolutely doesn't. And they can't control how much they take out because they're at the minimum that's set by the government. So at the very least, it's not that pre-tax is bad and Roth is good. It's the fact that it's kind of like chocolate cake. A piece of chocolate cake is delicious. But if you eat an entire chocolate cake, you're going to make yourself a little sick to your stomach. So what we really what we really want to focus on is what is the appropriate amount of money to have in each one of these buckets. Well, it's not 90% plus here, 10% here and 0 here. What we're teaching people is you can dramatically enhance, and I want you guys to listen to this, is important. You can dramatically enhance your retirement income by changing where that income is coming from. It's not just earnings. Because if you think about it, we'll make a simple example. Would you rather earn 8% in a 50% tax bracket or 5% in a 0% tax bracket?
Mm-hmm.
For some people, they can't get over, I want to earn 8%. I just want to earn 8%. Well, that's great when you're growing your money, but I got to tell you, you know what? When you go to retire, when you funnel through 5% to a 0 tax rate because it's coming from a tax-free asset, guess what? You get to keep that full 5%. But if you had an 8% return and there was a 50% tax on it, that's 4%.
Mm-hmm.
You're considerably better off having some money coming from tax-free. So what we need to be very mindful of, it's not rate of return. It's the amount of distribution that becomes net income that we get to put in our pocket and live off of. And that's where smart 401k plans are just so different and unique, because it gives you and your advisor, whoever that is, the ability, whoever your smart plans advisor is, it gives you the flexibility. You can hold any kind of investment you want in here. This isn't something where if you have a smart 401k plan, you've got to have a smart, like I'm your advisor. That's not how it is. This was built as an open architecture where advisors can use this however they deem appropriate for their clients to dial in the risk tolerance that they want. So we've got some people that have individual brokerage accounts with stocks and bonds. We've got other advisors who want to build almost a pension-like guarantee into this. They can do that. We can build it tax deferred or tax free. But we want to help them become more tax aware. We want to help them become more tax diversified. And now is the best time in history to do it. And that's really what smart plans are all about. Smart 401k plans and smart solo 401ks. If you get somebody, if you go to the website and visit our website here at www.smartplans.com, what you do is you go in here and there's a due diligence review. You can walk through here. There's so many different examples on here about, different ways that you can build your plan if you're an internet person, or maybe you're a builder that has a big job. But just because you have a job, if you have a side business that's different from your job, you might be able to put a lot more money away. Sometimes people are displaced. We have loan provisions in here. You can roll over an existing SEP IRA or other 401k and get it into a place where we can access that money for you tax-free via the loan provision so you can start your own business. And there's just a lot we can do here. And I think that the marketplace has been, mutual funds will tell you, hey, we can do this for you. Our plan designs are free. But sometimes free also means that you're free of options. You're given the default plan. And if you're free of options, you may be costing yourself an absolute fortune in the future because of how your plan is going to distribute, because you haven't built the tech flexibility. And you're going to distribute the way they built their product, not the way that's maybe most advantageous from a tax perspective based on you as an individual, you as a unique person. You're going to go to their default. And you know what? There's no two people alike. That's what makes the world a great place, right? So you don't want a default plan where one size fits all, because we're all different. So that's what the flexibility that's been built into these plans that makes them so unique. Can
you tell us a little bit more about the process of someone getting a plan design based on?
Yeah, I'd love to, Paul. It's really easy. This site was built specifically for that. So I think if you're sitting here and you're an advisor and you've gone through and you're doing the training that we put the Smart Plans advisors through, the first thing is you just watch this video. And it talks about all the things in the world, why having more money tax-free might make sense. And, I don't usually do this, but let's do it because I think the folks that are watching here would get a lot out of this. If you go to usdebtclock.org, we can learn a lot here. We can learn a lot from this, all right? It looks like a massive mess of craziness, but there's a lot of information here that people need to be aware of. We hear about this debt every about 6-8 weeks because the politicians need to go back in and say, yeah, we can borrow more money to keep the government going. Mm-hmm. But I want to make this real simple. There's 4 data points on here that mean a lot to me. Data point number 1, the interest that each citizen is paying. If you break it out, now understand, when we talk about interest, we're not talking about paying our debts down. We're talking about paying the interest on what we've already borrowed. So go back in time as far as you need to make this math make sense. Let's say that your credit card interest payment is $9,437 a year. Okay? But your income is only $10,258. That's not a lot of cushion, is it? Mm-hmm. That's not a lot of cushion. You better find a pretty cheap place to buy some noodles, because you're definitely not having any filet mignon, because you don't have any space here. The majority of your income is going not to pay your debt down, just to satisfy the interest payments on your debt. And we know that the second that the revenue coming in is less than the interest that we're paying, it's over, right? Mm-hmm. It's over. Now we're bankrupt. But you see, our government's different because they control something, don't they? They control the rate that they charge us in tax. So the reason I'm telling people today, we see it all the time. People come in with pre-tax money, 401ks, IRAs, and it represents 90, 95, 98% of their money. If taxes go up a lot, the value of that money goes down a lot. So what we want to do is get them more tax aware and more tax diversified. The other reason why income taxes are likely to go up, this is the workforce in the U.S. today, 157 million people. Of those 157 million people, 130 million people are full-time workers. Of those 130 million, about 8 million don't make enough to pay in the 10% bracket. So we have 122 million people that are paying income taxes in our country. So think about it as 122 million people paying in. If we go down here and consider the retirees who deserve everything they get, and the veterans who deserve everything they get, and the education the kids get, which they deserve, and the armed forces people, and the disabled, when you look at everybody, food stamps, Medicare, Medicaid, all of these recipients, there's 169 million people that are getting something from the government. We've got 122 paying in and 169 pulling out. So when you start looking at these statistics, and that's what the purpose of this video is, to say, look, the world is set up in such a way where future taxes are very likely to be higher. Now, we're not saying scrap everything you do today and go all tax-free, but we want to give the entrepreneur who's working hard, who's busting their butt to try to make a buck, the chance to have big company corporate-like benefit plans so that their retirement has flexibility to make it so that they get the most out of retirement and possibly the least loss to taxes. Right now, the average realtor who's out there putting their money in a SEP, what tax diversification can they do? You can only pre-tax. There aren't any other options. So we're opening up a whole new way for people to save more and control the tax on what they save. That's really what we're doing here. And we give a great example, especially for folks that are realtors. This is our Meet Susie. And Meet Susie, she's a realtor. And it talks about how she can get ahead by using a smart 401k plan. Let me tell you something crazy. Let's say that we have a husband and wife that are both working in an internet business, and they're both over the age of 50. Imagine this, they could put over $100,000 a year into a Roth. Imagine if a successful company did that, or a successful company started by a successful couple did that for 10 years. They would have over $1 million that they put in and have grown inside of a Roth. And every dollar that they would pull out of that in their future would be 100% tax-free. That's just not been the norm. So we had to build this. And the first person I built it for, Paul, was me, because I wanted it. So the prototype document that other people are getting is the same document that I'm using, that I use for myself, tailored to their specific situation. So if somebody wants to get into this, your advisor, your Smart Planz advisor, is going to take you here. They're going to kind of walk you through how this thing works. And then ultimately, you're going to go to this screen. And this is going to educate you about the process. They're going to take some basic information from you here, and they're going to walk you through the steps. And that's it. You're going to ultimately get with a design coordinator. And that design coordinator who works with Smart Planz, one of the 55 employees that are working there, to help you with what you're doing, they're going to talk to you on the phone with your Smart Planz advisor and figure out, can this work for you? And if it doesn't work, then the deposit you put down gets refunded to you. And that's it, man. I mean, it's just a really clean way for people to build a plan to better their future by creating more retirement and less tax. That's what we built.
All right. Hey, guys. So thank you so much for tuning in today. Hope this has been helpful. If the very least, what we want you to take from this is your ability to be more tax aware, so that the decisions you're making in terms of keeping more of your money, you have full control. You have the understanding to make those good decisions. Now, if you would like to talk to either Dr. Play or myself, feel free to reach out. And I believe there's going to be a button here that you can schedule a 15-minute consultation. Or if you're an advisor and you're watching this and you want to learn about how to become part of the Real Estate Tax Savings Hub, feel free to reach out as well. So, Dr. Play, any final thoughts?
Nothing to add, my friend. Just really excited, and we look forward to be speaking with some of the folks that are going to call in pretty soon.
All right. Fantastic. All right. Bye for now, everybody.
Take care. Bye.